Good morning. We will convene the May 2023 Consensus Revenue Estimating Conference. I am Catherine Summers. I am the director of the Senate Fiscal Agency. It is the Senate Fiscal Agency's calendar year to chair the CREC, so here I am. To my far left, Chris Harkins, the State Budget Director. Immediate left, Rachel Eubanks, State Treasurer. And to my right, Mary Ann Cleary, House Fiscal Agency Director. Any opening remarks from anyone?
No, ready to dig in.
It's better than January, right? Because we don't have to generally worry about weather in January, or in May, which is very nice. So appreciate everybody being here. Looking very much forward to seeing the presentations today. And with that, I think we will get going. Our first presentation is from RSQE. We will bring up Dr. Daniil Menyankov and Gabe Ehrlich, Dr. Gabriel Ehrlich. Daniil is an economic forecaster at U of M, lead research area specialist at RSQE, which is the Research Seminar on Quantitative Economics. Main areas of expertise: macroeconomics, monetary economics, and applied econometrics. Received his PhD in economics from the University of Minnesota, holds a Master of Science degree in applied math and physics from the Moscow Institute of Physics and Technology. He's been involved in forecasting in the U.S. economy for more than 15 years. Prior to joining RSQE, Daniil worked at the Federal Reserve Bank of Minneapolis, and so on and so on and so on, and we've seen him many, all great, wonderful stuff. Dr. Gabriel Ehrlich is an economic forecaster at U of M, where he's director of the university's RSQE. Published articles in New England Journal of Medicine, Review of Economics and Statistics, Journal of Urban Economics, Journal of, and more. So again, Gabe oversees RSQE's forecasts of the U.S. and Michigan economies, presents and gives interviews regularly about Michigan's economic and fiscal prospects, co-author of the U.S. Economic Outlook for 23-24, and the Michigan Economic Outlook for 22-24. I would like to welcome both of you up. Thank you very much for being here, and we look forward to the presentation.
All right, good morning, everybody. Let's see if I get this right. All right. So thank you for the introduction. Thanks for inviting us back. It's always a great pleasure and an honor to talk to you guys and to be a part of the budget process in this great state. So I have a ton of slides, although thank you for the extra time that you've allowed us. Still, I'm going to run right into my, all right, if I figure out how to, okay. So I'm going to talk about where we are right now, and it's going to be a bunch of charts, but some of them may look contradictory to one another. And basically, if you come away with no clear view of the picture of the economy, that's how we want you to feel, because that's how we've been feeling for the past several quarters. So the economy remains very difficult to read and forecast, and there are many different, quite divergent scenarios that are quite plausible now in our view. So what we're going to do today is basically synthesize them into a single outlook, which sort of averages them out. So let me start with a picture of where we were in the first quarter of this year. And on this chart, I have several recent quarters of real GDP growth in solid black line, and I have components of that growth in colored stacked bars. So I want to draw attention to few things in this picture. First, the size of the blue bar, which is the contribution of consumption expenditures to economic growth, has been very strong in the first quarter and has been the strongest since the second quarter of 2021. So that's a big part of what's driving the economy, and consumption has been doing pretty great in the first quarter. The second part is the yellow bar, which is business fixed investment. And it's been a drag in the prior 3 quarters, but it's been, you can't see it on the chart, but it's been virtually flat in this quarter, in the most recent quarter. So investment hasn't been as much of a drag. So on balance, if we sum the two things, consumption and investment, as basically private demand, it's been pretty strong in the first quarter. Now, the headline growth was not spectacular at 1.1%. That's because of the green bar that's dragging it down, and that's inventory investment. And it's basically for a few reasons, but one of them is unexpected growth of consumption. It had to come out of somewhere. It came out of inventory. In general, the green bar is volatile, as you can see from the recent history, and we typically try to look past it. So the headline was weak. The underlying growth was pretty strong. A word of warning, the bulk of activity that you see reported on here has happened before the recent banking stress episode emerged. So I'm going to talk about that next. First, 4 banks failed, 3 large or medium-sized, 1 very small, which you probably haven't heard about. Regional banking seems to be under stress. So what I'm showing you here is SP 1500, which is pretty broad index of publicly traded firms. And I have 2 banking indices plotted. One is for all banks, which is in dashed blue line. And the yellow line shows the sub-index for regional banks, which are typically smaller. The largest, so basically, historically, these 2 indices tracked each other pretty closely. But in recent months, you can see a significant divergence between the 2. And it's the largest divergence since the data that we have that goes back to 2003. So regional banks are obviously stressed more, but I also want to stress that the broader banking index is off 40% of its recent peak. So broader banking is also under stress. So we don't have access to detailed bank-level statistics. We can only look at the macro data. And we have looked at a bunch of statistics from the Federal Reserve. It's not obvious what's driving the stress. So some of the stories that are out there, like, I know, banks bought too many treasuries and then they fell in price. Regional banks actually hold less of them. So large banks should be under more stress, but they aren't. So I'm going to show you a few things that may be related, maybe not. But it's, like I said, it's not obvious to me or to us what's driving things. Still, I'm going to show you first is what's happening, what has been happening for the past several decades on the balance sheets of large and small banks. So Fed H8 report splits out domestic bank by large ones, which are the top 25 banks by domestic assets, and the smaller ones, which is everybody else. Here I'm showing you the share of assets invested into commercial real estate. And historically, regional banks do a lot more of that. So on average, it's about 30%, maybe between 25 and 30%. Larger banks do a lot less of it, lately about 6 to 7%. So it's not a new trend, but right now, commercial real estate is in some trouble. So some indices of prices in commercial real estate are down 15, 20% year over year. Hybrid work is not going away as quickly as some thought, so it's basically lingering. That lowers the demand for offices and also lowers the volume of activity, economic activity that's happening in city cores. So basically, a lot of business projects in commercial real estate are threatened, and that might be one of the reasons why the focus is on regional banks. Now, next I'm going to show you what's been happening in the banking sector, which probably somewhat related to the stress, but it's been going on for a while. So here I'm showing you the percentage of liabilities of commercial banks that are deposits. And you can see that there's an outflow of deposit, and it's been happening for more than a year now, starting sometime early in 2022. And the story is basically short-term interest rates rose, banks were not willing to follow along by raising rates that they pay on their savings and checking accounts, and people voted with their money. They basically moved them to, Treasury Direct, money market funds. So they've been bleeding the source of funding, and it's been going on, and the banking stress supercharged it, as you can see in the recent data. The decline in the regional banking level of deposits is much more pronounced. So banking is basically under stress. The way they know to fix the stress is to improve the quality of their assets. So we think they're going to tighten up credit standards. They're going to be lending only to a safer borrowers. And that's basically a credit crunch of different severity could happen. We are assuming a modestly tighter credit, and that's going to cost us some growth, but not too much. And not too much because of the next slide. So the next slide, here I'm showing you measures of risk aversion in the economy. So I have the credit spreads for risky debt. I have CCC and lower in the yellow line, and that's basically high yield debt. And I have BBB rated debt in the blue and dashed line, and that's like one of the lower grade investment grade bonds. They are on separate axes, so one is higher, and that's the left axis, and the other one is on the right axis. They track each other fairly well once compressed into different axes. And the thing I want to take away from this chart is that the level of stress right now in recent weeks is not that high. It's maybe a little bit elevated, but it's certainly not to the point that it's been over the past even a decade when, I don't know, shale crisis and some of the stress episodes in the recovery from the Great Recession. So we're not seeing a broader credit crunch or not severe credit crunch emerging at the moment. I want to caution you just briefly, if you look at the yellow line, it's currently at the level that it's been between the failure of Bear Stearns in March of 2008 and the failure of Lehman in August. So it's an alarming state that it's not obviously stressed. All right, so let me get to a more regularly scheduled programming with more economic slides. And the bigger story is what's happening to inflation. So here I'm showing you two charts, the headline inflation, the year-over-year rating in yellow, and core inflation in blue. So headline inflation is falling quite significantly in recent months. It's largely driven by sharp declines in energy prices, leveling off of food prices, but also significant disinflation in goods, both durable and non-durable. Core inflation appears to be much more stubborn, and part of the story there is that shelter, that is rents, a component has been very strong, and it's actually lagging what is happening in the rental market by several quarters. By some other measures, rental market is cooling off quite rapidly. So we expect over this year, the shelter component of the core CPI will slow. It will help some, but not dramatically. So it will. So there are other parts of the economy that are in core where we don't see much sign of slowing, and I'm going to turn to that part right now. So here I'm going to be looking at core PCE, that is personal consumption expenditure deflator. So that's a larger basket compared to the CPI, and it includes a lot more services. So core services are going to be services less food, basically restaurants, and less energy services. So think about home heating. We're also going to abstract from housing and rents just to look what's left. And what's left is basically your regular services. So think about accountants, dry cleaners, amusement park workers, and so on. And here, I'm showing you two things. I'm showing you the year-over-year pace in yellow, and I'm showing you the recent pace over 3 months averages. And both of them are not showing any slowing whatsoever in recent months. And we think that this part of the economy is more sensitive to wage pressures. And it's not surprising that it's not slowing because wages are growing pretty briskly so far. So I'm going to show that next. So here I'm showing you two measures of wage pressures. Yellow line is the Atlanta Fed median year-over-year wage growth tracker, and it's built from the ground up from microdata in the current population survey. It's hanging pretty high. The other measure is the employment cost index for wages and salaries. And it's a little bit different that it's controls for changes in the industry mix. So basically, if one industry is growing very, very fast, hiring and paying high wages, other statistics might pick it up and may be somewhat skewed. The employment cost index sort of uses the fixed industry composition. And it's also showing continuing and strong wage growth. So we think the Fed is paying attention to these charts very, very much. And it is likely that it will take some labor market cooling to bring wage inflation and the price inflation in the wage-sensitive parts of the economy down. So we expect there to be a slowing that the Fed will be happy to tolerate as long as that basically helps wages slow down some. Quick look at what's happening in the residential housing market. Here we had a dramatic falls during 2022, which appear to have stabilized. So I'm showing you two things here. Mortgage Banker Association application index for purchases in yellow, and National Association of Home Builders housing market index in blue. So you can see that the applications have stabilized in recent weeks and are basically scraping along the bottom, but they're not falling. The other index is what we call a diffusion index. So basically readings below 50 say things are getting worse. This index collapsed over 2022, fell to like readings of close to 30, and then improved, and the most recent reading is 50. So basically it says that things have probably stabilized. So it's not improving, but the whole market appears to have adjusted to the new higher level of mortgage rates, which came off their recent heights of about 7%, but they're now about like 6.4, which is not spectacular, but the market appears to be adjusting. A quick look at more surveys. So here I'm showing you the Institute for Supply Management's Purchasing Manager Diffusion Indices, and these are for manufacturing in yellow and services in blue. So again, these are indicating the direction. If the reading is above 50, means the sector is expanding. So here you can see that the manufacturing index has been in contraction since December 2022, and it's not really showing signs of improving. And we have some other surveys that have longer outlook, and they're not doing great. What's more concerning is that the service sector index has stepped down considerably in the last couple of months from a level of about 55, which was indicating solid growth, to about 52, which is considerable slowing. And the reason it's concerning is that over the past several quarters, services has been the engine of growth in the economy. So basically this stepping down means that maybe services will slow down and the overall economy may cool as well. And let me finish the economics part of where we are in terms of what's happening to the broader employment market. The payroll job gains that I'm plotting here are month on month, and one thing I want to point out is that there appears to be a downward trend. So if you average, for example, February through April this year, we averaged about 220 jobs per month. We can compare it to a year ago, where the same reading for the same period was about 500. So things are slowing, but on the absolute sense, 200,000 jobs a month is nothing to sneeze at. It's basically a decent level. So things are slowing among some other metrics that are not shown here, although the unemployment rate is holding up so far. Unemployment claims are inching up. We have some data on what's happening to job openings and job openings rates. Those are sliding. We have the rates of layoffs and separations. Those are rising, but again, they're still fairly low. So to sum up the labor market, it remains fairly strong, but the trajectory is for softening of the labor market. Now, before I turn to the forecast, let me talk about the elephant in the economics room, which is happening with the debt ceiling. So here I'm showing you a measure of credit default risk for the United States. There are three lines. They are credit default swaps for 6 months, 1 year, and 5 years. And the message here is that the current episode appears to be a lot more stressful than the previous ones that we went through in 2011 and 2013, at least based by the perceived probability of default by financial markets. So the overall probability inferred from these readings is about 2%, which is insanely high. Now, we assume that the deal is still imminent because the costs of not doing so are pretty significant. There's not much time left to do things, so we think there's going to be some short-term agreement, maybe a verbal deal, temporary short-term increase in debt ceiling, and then a broader agreement over the summer, which will either exercise some spending restraint or maybe repeat the solution to the 2011 episode where there was a commission established to study things, which had a fallback option of discretionary spending caps. I'll talk a little bit more in the next slide. So let me jump into the forecast, and first let me talk you through our policy assumptions. First, we think the monetary policy that is the most consistent with our outlook is that the Fed is going to take a pause for the remainder of the year, and they're basically going to be banking on policy lags doing the rest of the job. So economic research basically says that once you raise rates, the full effects can take a couple of years to phase in. So we have administered they have administered about 5% of short-term rate increases over the past year, and those will probably be having an effect on the economy for the next couple of years. So they're going to be basically hoping that those are sufficient to slow the economy down. After that, we think the Fed is going to start easing policy once their own and consensus inflation forecast for a year or two out show a return to 2% PCE inflation, which is not there yet, but will probably be there by the beginning of 2024. And at that point, we expect them to start cutting rates gradually. Now, on the fiscal policy, with divided government, the debt ceiling fight is not going to be the last contentious point of contention. There's probably going to be some spending restraint as a result, but we think it's going to spare defense spending. So we think the discretionary non-defense spending is probably going to take the bulk of the hit. We don't think it's going to be enough to make a dent in the federal deficit. It was about 4.3% last year. We expect it to average about 5.8% over this and the next 2 fiscal years. And the key reason why is that interest payments are projected to balloon quite significantly because of higher interest rates. Now let me jump into the forecast, but before I do so, I'd like again to remind that the uncertainty is very high. There are multiple believable scenarios which are quite divergent. So what we present you here is some middle ground between what we think is plausible. So we think the contraction is still more likely than not at the end of this year. So here I'm showing you the quarter-on-quarter annualized pace in the blue line and annualized averages in yellow bars. So we think a contraction is going to happen, but it's going to come late because the near term, we still have plenty of momentum. So we expect a quarter of negative growth by the end of 2023. The big driver of the slowdown is consumption, which is going to be held back by higher interest rates, falling real disposable incomes, and maybe some tighter credit standards. We expect fixed investment to be fairly flat through mid-2024 when the Fed is going to start cutting rates. It's going to help with the lag. Government contribution to growth on balance is a mix with strong contribution from defense spending, but everything else, including non-defense and state and local, is not going to be doing great. And as the Fed starts cutting rates in 2024, with a lag, we expect the economic activity to accelerate to above 2.0% pace by the end of 2024. The implications of this outlook for employment are plotted here. Again, strong momentum in the near term, a slowdown sometime late this year, a weakness through 2024, and then we expect the activity to pick up. During the weak spot, we project about 500,000 losses, which is not that much compared to historical recessions. We expect job growth to ramp up to 200,000 jobs per month range by the end of 25. Implications of this outlook for the unemployment rate. Here, we expect unemployment to begin softening towards the end of this year, rising to about 3.7% from 3.5% right now. Unemployment peaks at about 4.1% in 2024 and then gradually improves. We have a little bit of movement on the participation rate, which is due to the labor market softening, but essentially it stays flat at its most recent level. Implications for inflation are plotted here. Headline CPI and inflation is projected to run below core because food and energy price inflation is expected to lag behind. We project some progress on inflation this year because shelter inflation is going to slow, but a more meaningful progress is going to take some softening of the labor market, and it's going to happen during 2024. And we expect core CPI to drop to 4% year over year by the end of this year, but to about 2.7% by the end of 2024, and then edge down a little bit to 2025. So basically the story is that the softer labor market is going to be required to bring inflation down. and I'm going to skip this slide, and I'm going to talk a little bit about what's happening to housing starts. Here I have 3 lines. I have the total housing starts, and I have the single family and the multifamily starts, and they behave differently, so let me talk through. So the single family home market has been stressed. The level of starts is down significantly from where we were during the pandemic. We think the housing market is stabilizing, and it's probably going to bottom very, very shortly, maybe this quarter or next. And then it's going to grow gradually, rising from about 820,000 starts this quarter to about 900 by the end of 2024 and about 940,000 by the end of 2025. The multifamily starts were actually doing great over the last few years because rents were so crazy, they were building a lot more of it. Now, there is a lot more construction that's about to come online. It will come in, depress rents some. The labor market is going to soften. It's going to depress rents some more. And because of that, we expect a softening of the level of multifamily starts. They're going to fall from about 550,000 to about 420,000 by the end of 2025 and stay there. Now I have a slide on risks. It's dense. I can talk about this for ages, so I'm not gonna. You're welcome to ask any questions about what's on this slide when in the Q&A session. So I'm going to turn it over to Gabe. Thank you.
Thanks, Daniil. And let's see, what are we doing? There we go. Okay. Well, yeah. Thanks, Daniil, and thanks very much, for inviting us to be here today. It's always an honor and a pleasure to participate in the Revenue Estimating Conference. My name is Gabe Ehrlich. I'm the director of RSQE, and thank you, Catherine, for the introduction. I will go ahead and get started. I'm pleased to share our outlook for Michigan's economy today. Before I do that, I just want to give you a brief snapshot of where Michigan stands in the current economy and in the data. This slide shows Michigan's employment recovery in the blue line to the national employment recovery from the pandemic in the yellow line. And what you can see, both lines are indexed to a value of 100 in February 2020, so just before the pandemic. The U.S. economy lost about 14% of its payroll jobs at the start of the pandemic, and it had recovered all of those losses by the middle of last year. And in the most recent data, payroll employment in the United States is about 2% above where it was before the pandemic. Michigan experienced a substantially deeper initial downturn. We lost about 24% of our payroll jobs at the start of the pandemic. Through April, we've recovered to within 1% of our pre-pandemic employment level. So, we're making a lot of progress. In the jobs report that we got yesterday for the state, we were about 30,000 jobs short of a full recovery. We lost over 1 million jobs at the start of the pandemic. So, we're almost there. We're not quite there. You can see we're almost out of the hole. Not quite done yet. This slide shows total job postings from Indeed, and it really piggybacks on some of the comments that Daniil made about the national economy. So these are job openings on Indeed. It's not official government data, but it does tend to track the government data pretty well. It's more timely and it's more granular than the government data, which is why I like to show it. And again, I've indexed things to a value of 100 in February of 2020. As everybody will probably recall, job openings fell. It was kind of a scary time for the economy, obviously, in the second quarter of 2020. But then, we just saw an incredible rebound in labor demand, as we moved through 2020 and then into 2021. And you can see at the end of 2021, job openings nationally were about 60% higher than they had been before the pandemic. They started to turn over in 2022. For most of the year, there was a very gradual deceleration or cool off in labor demand. And then as we got towards the later part of 2022, you can see job openings really started to cool off in a more noticeable way. In the most recent data, job openings are about 30%, just over 30% higher than they were before the pandemic. You can see, the labor demand is a little bit weaker in the Detroit metro area. It's a little bit stronger in Grand Rapids, and then Michigan is kind of right in line with the national average. Just one thing to point out is we've indexed things to just before the pandemic. That was a pretty healthy and pretty tight labor market already. And so it's, we have substantially more job openings now than we did back then. So, to Daniil's point, despite the fact that we are seeing things cool off, it's still a pretty tight labor market. So I would, describe it as it was very overheated. Now it's, somewhat overheated, but it's, still overheated a little bit. Okay, so with that, I'll move to our forecast. This slide shows you our quarterly forecast for total U.S. light vehicle sales in the yellow line and Detroit 3 light vehicle sales in the blue line. National light vehicle sales totaled about 13.8 million units last year. And you can see we've had a pretty, noticeable recovery just in the past, few months. We're projecting unit sales to climb to about 15.4 million units this year as supply chains continue to recover. But we do expect the recovery to be limited by high prices and higher vehicle financing rates or interest rates. So those will both put a dent in demand. And I should say, we're not completely out of the woods in terms of supply chains. You still hear stories about problems on that front, but certainly the situation has improved a lot. Light vehicle sales climb a bit further to 15.7 million units in 2024, and then to 16.4 million units in 2025. So that would obviously be a very welcome recovery, but it would still be below the pre-pandemic level, when sales were running consistently above 17 million units for several years. Our forecast calls for the Detroit 3 sales pace to increase from 5.3 million units last year to about 6 million units by 2025. And again, that would be progress, right? But it wouldn't get us back to where we were before the pandemic. And one reason we don't expect a complete recovery in terms of unit sales is that we do expect the Detroit 3 and other manufacturers to prioritize pricing discipline more than unit sales volume. So it's not just about shipping units; it's also about maintaining some margin. And that's in contrast to some previous cycles when sales volumes were maybe more of a priority. So turning to jobs, this slide shows you our forecast for payroll employment in Michigan through 2025, along with the history going back to the start of the 2000s. We're forecasting job growth to slow down from 164,000 job gains last year to about 68,000 job gains this year and 45,000 in 2024, and then 42,000 in 2025 as we continue to edge above where we were before the pandemic. We're projecting Michigan to recover to its pre-pandemic employment level sometime later this year. That's a little sooner than we had projected in January. If you recall, we thought it would take into next year to get there. That reflects revisions to the data for 2022 that we have now, along with a strong start to this year. I do want to just take a minute to explain why we're forecasting continued job growth here in Michigan, even as the national economy slows down. And as I'm sure you all know, that's not the historical pattern, right? The historical pattern is when the U.S. economy catches a cold, Michigan catches the flu, right? And we're kind of saying this time is going to be different, which are, economists typically end up regretting that message. So, but we're cautiously optimistic still here for Michigan. And on this slide, what we've done is divided Michigan's industries into 3 different groups, and we've plotted our forecast for employment for each of those groups, again, relative to the first quarter of 2020, so just before the pandemic. And the main reason we expect this time to be different and for Michigan to keep adding jobs is because of resilience in our blue-collar industries, and in particular the auto sector. Michigan's blue-collar industries, you can see, have now made a full employment recovery from the pandemic, and in fact, they did that last year. As we've discussed, auto manufacturers are still grappling with supply chain problems, and there are still large backlogs of demand in the auto sector. And so they're really still in the process of rebuilding inventories from the microchip shortage. Supply chain challenges do remain present in the industry. And with that in mind, we expect the backlog of demand from the shortages to cushion employment in the auto industry, even as the national economy slows down. And we're forecasting that auto manufacturing will add about 2,000 jobs per year here in Michigan from 2023 to 2025. And I should note, battery plants are not included in those numbers. I do want to, just acknowledge that we have not built in a strike, from the UAW into this forecast, and I'll talk just a tiny bit about that later on. The odds of a strike have been rising recently, in our judgment, and a prolonged strike certainly does have the potential to be disruptive for the state economy. That's not in our baseline forecast right now. Looking beyond the auto sector, we actually expect pretty respectable job growth in nearly all of Michigan's blue-collar industries, the exception being mining. And in total, we project the blue-collar industries to grow to a bit over 4% above their pre-pandemic employment level by the end of our forecast. Moving to the yellow line, We define higher education service industries as service industries that typically require a bachelor's degree or more education. So these are essentially the state's white-collar jobs. And you can see we're just getting now to a full employment recovery from the pandemic in these industries, in the white-collar industries. And our outlook for these industries is basically for continued but slowing growth. So we're projecting employment growth in these industries to decelerate from about 2.4% last year to about 1.8% this year, and then about 1.1% per year in 2024 and 2025. And with that, white-collar employment in Michigan climbs to about 2.4% above its pre-pandemic employment level by the end of 2025. And then finally, the state's lower education service industries are shown in the green line, and these are service industries that typically don't require a bachelor's degree. You can see they lost the most jobs by a significant margin at the start of the pandemic, right? So part of the reason that the recovery is lagging is just that, they were climbing out from the deepest hole. And, you can see we do expect steady but moderate growth ahead for these industries. One thing that limits the pace of employment growth in these industries is that retail trade is included. And so, the shift to online commerce, just continues in our forecast. And so there are job losses in retail. That does limit the pace of recovery here. By the end of 2025, we project Michigan's lower education service industries to remain about 0.5% below their pre-pandemic employment level. So this slide shows our forecast for Michigan's unemployment rate alongside the national rate. So Michigan is in blue, the nation is in yellow. And Michigan's jobless rate averaged about 4.2% in the first quarter of this year, and it actually came in at 3.8% for April in the numbers that were released yesterday, which was the lowest unemployment rate here in Michigan since March of 2020. We expect unemployment to hold at roughly, the first quarter level through most of this year before rising to about 4.5% by the middle of 2024 in the wake of, a slowdown in national economic growth that we're forecasting. As the Fed eases up on the brakes and economic growth picks back up, we see Michigan's unemployment rate start to turn back down after the middle of next year, falling back down to about 4% by the end of 2025. And, all of those numbers are, they tell a story, but I think the important thing to take away from this slide and this projection is just the era of tight labor markets in Michigan is here to stay for the foreseeable future, as far as we can tell. And, we were talking about this, before the pandemic back in 2019, we would say, listen, Michigan is going to be facing an era of labor shortages. The pandemic disrupted that narrative temporarily, but it's definitely back now. And, a lot of it is demographics. This slide shows our projection for Michigan's labor force participation rate. And, it fell sharply at the start of the millennium, for the first decade of the millennium, and then again during the pandemic. It averaged 59.2% in 2021, which was down from about 61.8% in 2019. In the scale of these things, that's a very big decline. It recovered a little bit last year. It averaged just under 60%, 59.9% last year. And you can see we're projecting a pretty limited recovery from here. We're expecting Michigan's labor force participation rate to average 60.1% in 2025, which again would still be well below the pre-pandemic level. I hope we're wrong about this forecast because it's going to be increasingly tough for Michigan to add jobs in the years ahead if we don't have more growth in our labor force. That's really going to be a speed limit on economic growth here in the state. And I do want to acknowledge we got some good news on the labor force in yesterday's job report for the state of Michigan. So hopefully that'll be the start of a trend and not just a blip in the data, but we've been head faked before by 1 month's numbers. Okay, so moving now to incomes. This slide shows our forecast for Michigan's personal income per capita in the yellow line and then real disposable income per capita in the blue line. We calculate real disposable income by subtracting personal taxes from personal income and then adjusting for inflation. So it's, a useful way to track living standards over time. Personal income per capita in the yellow line, which is the one that's, really growing over time, jumped during the pandemic with all of the stimulus money. And then it essentially treaded water in 2022 because labor income was growing. Jobs were still recovering, wages were growing, but we didn't really have that much federal, stimulus money in 2022, especially relative to 2021. We're expecting to return to a smoother growth path over the next few years, with personal income per capita ending our forecast almost 30% higher in 2025 than it was in 2019. But the blue line shows you the problem right? Which is that inflation is going to eat away those gains, almost all of them. Real disposable income per capita jumped by about 8% in 2020, but the spike in inflation has now reversed those gains. And we actually estimate that real disposable income per capita in Michigan declined by nearly 10% last year. And that's why so many people are sour about the economy, right? If you ask people, and the University of Michigan, runs a survey, and they, ask people how do you feel about the economy, and people say, well, it's terrible, right? And it's like, well, but the unemployment rate's at like these generational lows, and et cetera, et cetera. But the reality is, incomes are not keeping up with inflation, and especially last year they did not. So we're forecasting that Michigan's real disposable income per capita will hold flat this year and next year, and then growth will pick up to 1.7% in 2025. What that means is that by 2025, Michigan's real disposable income per capita will actually still be lower than it was in 2019. So, I think our forecast is mostly good news. We're calling for Michigan to avoid the brunt of the national recession, but state residents will see a decline in living standards over a period of 6 years, from 2019 to 2025. So that's, I think, the somber part of the forecast. In January, so I want to switch gears now and just spend a little bit of time talking about the long-run economic future for the state. In January, we presented some information from the long-term forecast we produced for the Michigan Department of Transportation last year. And to get a better sense of the range of possible outcomes and to think about what factors are most important in driving Michigan's economic future, we also examined some alternative economic scenarios. And I wanted to talk about some of the scenarios related to vehicle electrification today. I just want to acknowledge that the Southeast Michigan Council of Governments sponsored this analysis for the Southeast Michigan region, and that's what made this work possible, which is statewide. So just to give you a rough sense of what was in our baseline forecast, we had projected that about 10% of new U.S. vehicle sales in 2025 would be totally electric. So when we say electric vehicles, it's entirely electric, no plug-in hybrids, nothing like that. That's included in the internal combustion engine vehicles in this chart. We had estimated that the percentage of EV sales, new EV sales, would climb to about 25% in 2030 and about 55% in 2040 before getting to all EVs in 2050. So that's a slower path of EV adoption than some people in the industry, but I think everybody would acknowledge there's a big margin of error around all of these projections. One point I want to make with this chart is that newly sold electric vehicles replace the existing fleet that's on the road with a delay, right? The service length of new vehicles continues to grow. ICE vehicles are going to be with us for a long time. And so even by 2050, you can see on this slide, we're projecting about 50% of the vehicle fleet on the roads will still be traditional vehicles. So what we did is we considered two alternative scenarios related to vehicle electrification. Our baseline scenario is shown in the blue line, and what this is showing you is auto manufacturing employment in the state of Michigan. So it's motor vehicles, bodies, and parts manufacturing, technically. Our baseline scenario is in the blue line, and then our two alternative scenarios are in the green and yellow lines. The first alternative scenario in the green line shows you what would happen with a faster shift to EVs. And basically, we assumed that the shift would occur about a decade more quickly than in our baseline forecast, so that 100% of new vehicle sales would be fully electric by 2040 or so. And in this scenario, national employment in motor vehicles, bodies, and parts manufacturing declines by about 30% in 2050 compared to 2019. And one thing my team insisted that I point out, when I ran through the slides, they said you have to mention, we're using the BEA's employment measure here, which has grown more quickly than the BLS estimate that I discussed in my previous slide. So that was my duty to my team, was to acknowledge that. The second alternative scenario here is in the yellow line, and this is really a more concerning scenario for Michigan. It assumes that in addition to the faster transition to EVs, Michigan is relatively unsuccessful, right, in making the transition. And specifically, we assume that Michigan's share of U.S. auto manufacturing declines from about 18% as of 2019 to about 12.5%. In 2050. And that would be about the same proportional decline as we saw in the first decade of the 2000s. So we had estimated that there will be about 150,000 jobs in auto manufacturing in Michigan in 2050 in our baseline scenario. That job count falls to about 130,000 in our first alternative scenario as of 2050, because EVs require less labor to produce than internal combustion engine vehicles. But in our faster EV adoption plus loss of market share scenario, Michigan's job count in auto manufacturing falls to a little bit under 90,000 jobs by 2050. But, you know, the reason that's so concerning is that every job in Michigan's auto manufacturing industry supports multiple jobs statewide. And, you know, I know that's you know, broadly accepted, but I just want to give you a sense of the magnitude. The job losses in these alternative scenarios relative to the baseline are substantially larger for total statewide employment than they are just in the auto manufacturing industry. In our faster EV adoption scenario in the green line, the approximately 20,000 job decline in statewide auto employment by 2050 relative to our baseline forecast translates into roughly 110,000 fewer jobs statewide in total. In our faster EV adoption and loss of market share scenario in the yellow line, there's roughly a 60,000 job loss relative to the baseline in the auto manufacturing industry by 2050, but total employment is about 330,000 jobs lower statewide. And in that scenario, statewide employment is actually lower in 2050 than our projection for 2025. So basically making an unsuccessful transition to EVs has the potential to cost Michigan essentially all of the job growth we're projecting over a period of about 25 years. So on that cheery note, I'll wrap up. Just to summarize our outlook for Michigan, we're forecasting a complete recovery in payroll employment, hopefully by the end of this year. Despite that, we are projecting the unemployment rate in the state to rise to about 4.5% by the middle of next year in light of the national economic slowdown that Daniil showed you. Personal income per capita in 2025 will be nearly 30% higher than it was in 2019, but inflation is going to devour all of those gains. Most of the near-term risks we see are tilted to the downside. Again, you know, like Daniil said, I won't run through them all. I'm happy to answer questions about them. But, longer term, an unsuccessful transition to electric vehicles is a substantial risk to Michigan's economic future. But I do want to, I feel like that sounds like a real bummer, and I want to say, despite those risks, really our baseline forecast for Michigan's economic future is relatively upbeat. We believe the state can avoid the brunt of the national economic slowdown we're forecasting and continue to add jobs. And that would be really, very welcome news in a state that too often has suffered disproportionately when the national economy slows down. So with that, Daniil and I will be happy to take questions. Thank you.
Well, thank you both. Gabe, I also have a long track record of delivering good news with a bad tone, so I can sympathize a bit. One of the things that we talked about on the national level was some of the housing issues, but certainly we know we have a need for additional housing in this state, in particular affordable housing. Is that a thing you might be able to speak to in terms of housing starts or simply rent? On the state level, I think Daniil did a really nice job of explaining where we're at nationally. Yeah,
I think some of my own personal research, this is an area that's very, dear to me. At the end of the day, the way to have a broadly affordable housing stock is to have more housing in the state, right? And so, building more, it's got to come in all, parts of the market. Something that often worries people, and I understand why, is that most new construction is going to typically be aimed at at the top of the market. It's the housing stock does get nicer over time, and so when you have new houses built, it tends to be expensive. But something I like to emphasize is that the affordability effect kind of filters down through the market over time, because when you build new housing at the top of the market, even if it's market rate housing, right, it adds to the total stock, and you'll have higher income people will move into that new housing. It creates vacancies in the existing housing stock that then can create affordable housing for other people. That sounds, it might sound like a just so story. I think that there is empirical evidence that mechanism does work. So something I just always emphasize is that expanding the supply of housing is an important way to make sure housing is affordable. And I do worry with the rise in mortgage rates that is has the potential to cool off housing. We do expect permitting activity to fall in the state. That is part of our forecast. But something that Daniil pointed out, we haven't seen, one thing to point out, we have not seen job losses in the construction sector, and that's been good news, and that's part of what underlies our forecast. And it does seem like the market is adjusting to the higher mortgage rates, a little better than I think we had hoped, 6 months ago, so that's good news.
I just want to briefly add that to make sure that all the home builders have a market to target, we really have to have like working population growth. Because if population is stable, there's not much reason to build new stuff.
So we'll just go to your last bullet. What does an unsuccessful transition look like? Is Michigan on that path, or are they okay? Or,
I think it's a very contested space. I think it's too early to say. The kind of that yellow line scenario that we showed is kind of our version of, well, what would an unsuccessful transition look like if, losing market share the same way that we did at the start of the 2000s. I think I think that the industry is in more flux than, we've seen in a long time, and I think it's too early to predict how it's going to shake out. I wish I could give you something more concrete, but I think honestly, I think the range of outcomes is pretty wide. And something to point out is we often think about the competition among the existing automakers, and we think about Michigan and the Midwest versus the South potentially. But something we are seeing is now with EVs, there are new entrants into the manufacturing space, and it's not to say that they're all going to be successful, but obviously Tesla is the most famous example, but we've certainly seen other entrants, and so who knows, 30 years from now we could be looking at a future where there are entirely new companies based who knows where that we don't even know about today. So
thank you. You also shared a scenario where EVs have the green line, the moderate projection, and a faster acceleration towards acceptance. What are the factors at play in achieving investments or necessary steps forward to make sure we have faster acceleration?
that's a great question. Thank you. So I think government policy is going to be a part of the pace of acceptance. I think that one question, there are questions about the technology. What does the cost curve look like? Certainly, we expect new models to become available in a variety of different form factors. I think that will drive acceptance. Obviously, the tax incentives are a big part of the story, and then part of the story is just the regulations. What will the government do in terms of ICE vehicles versus EVs? And I think, like I say, it's when we talk to people, we've compared our projections for the pace of adoption to others. Relative to some people in the industry, I think we're projecting a slightly slower pace of adoption, but certainly we've talked with people who have even slower projections than ours. So I still think it's a very open question, what exactly that line looks like. Daniil, do you have any thoughts to add?
I just want to add more caution, basically, because, these are scenarios, but we have a way to assess if the mix of cars is changing, but we don't have any good data to see what sort of other jobs the EV transition might create. So, you're going to need to have, the electric grid upgrades to make sure charging is adequate. And having a lot more charging will certainly go a long way into encouraging people to own EVs, and that's probably going to generate jobs. So, these are like our best guesses based on what we know, but there is a lot that's unknown and couldn't possibly be known at the moment. So take these with, caution.
Thank you.
So first, Gabe, I just want to say I appreciate your refreshing message about, Michigan's economy performing better than the U.S. economy during an economic downturn, and in particular, touching on that industry that, we've often been criticized in past recessions, the auto industry and how that has hurt us in downturns. We're here, it's really helping us, so much appreciated. But just shifting gears, and it wouldn't be a crack if I didn't ask you something about consumer consumption and behavior over this time, and kind of wondering, it wasn't in your presentation today, and wondering if, we can kind of close the loop or, kind of end the story on pandemic spending and unusual behavior away from trend and kind of think about us returning to whatever our new normal is. I mean, obviously, the sales tax forecast continues to be very difficult to forecast out, and we've forecasted kind of flat sales tax growth in the next couple of years. And so just kind of curious if you have any thoughts there.
Yeah. Well, thanks very much, Rachel. Daniil, do you want to?
Right. So I want to start with recent data. Consumption isn't falling as fast, at least goods consumption, that is the focus of sales tax, is not falling as fast as we thought. And one thing we know about consumption is it's sort of habit forming, and it takes a while. So I think it's still a safe bet to expect some gradual return to pre-pandemic trends, but they'll probably take a while. We're still not exactly sure how much money people still have in their savings accounts. So if you look at the government statistics, there are still trillions. If you look at aggregate financial wealth, it's maybe not so overblown. So there are reasons, like I said, there are many scenarios. I can envision a scenario where people just keep spending, and that overwhelms anything the Fed is attempting to do. It may end up with, I don't know, higher inflation sticking around, but consumption is going to keep going, inflation is going to keep going, and that's going to make sales revenues just, I don't know, maybe not even level off. So like I said, it's possible to envision many scenarios. On the other hand, banks are somewhat stressed, and they're probably going to tighten, I don't know, credit card spending, credit card standards, and that might constrain things. So I'm not going to be more helpful. I'm just going to tell you like more different scenarios.
Thank you. Can you start to describe the cost to the state of Michigan and the threat of congressional Republicans driving us over the debt ceiling, failing to act to solve that issue?
Yeah, so I think a few things about going over, the debt ceiling. We think about it as a binary event. I think the effects would really depend a lot on how much do we go over the debt ceiling. I think, we've talked a lot about different scenarios, and I think the reality is anybody who tells you that they know what would happen is extrapolating, because we've never been over. We don't have a historical precedent. I do think that, as Daniil showed you, there are already some, signs of stress in the economy about that. But I think, if we had a very short term go over, for say several hours and there was a panic and they came to a quick deal, my guess is that's a manageable scenario. What worries me a lot more is if we go over for a prolonged period of time where, people are not getting checks that they were counting on, contractors aren't getting paid, Social Security maybe, gets delayed, and certainly if we had a breakdown in the financial system because of it, then I think it would be a much more serious scenario. So I think a lot really does depend on the details, and I think, we don't know what exactly it would look like. So it's definitely something that worries me, but I don't have, something really concrete to say quantitatively about, well, what would this look like, because we've just never been there. Daniil, do you have anything?
Right. So, I mean, I want to echo the comments is that there are two things going on. So there is a debt ceiling that may trigger a default, but then there's also the banking stress. And the combination of the two is the thing that makes it scary, because the banks are in a precarious state, which seems to be vulnerable to more shocks. And it's still a low probability event. If the Fed stops payment on some Treasury securities, it can trigger a financial stress episode, and that's going to have a much bigger impact on the broader economy and Michigan as well. Another alternative is that they're going to try to keep the debt and principal and interest payments rolling, but start cutting other obligations, Social Security, and that goes directly into consumption. So that's basically going to be a immediate onset consumer-driven recession. So that's also going to have implications for sales tax revenues and basically a lot of downstream consumption that depends on people who are on fixed income and who will not be able to get it.
I mean, just if I can just, I do want to say, that's not in our baseline. You know, we still consider that to be very much a tail risk to the economy.
Thank you so much. We appreciate the presentation and the information, as always. Thank you. And we are right at 10 o'clock, right on our agenda. So I would like to introduce and bring up Dr. Jacqueline Butler to talk about Michigan demographic trends. Dr. Butler is the state demographer for Michigan. Dr. Butler and her team analyzed population data for the state and advised state and local leaders, nonprofits, and the general public on the sources, uses, and limitations of census data. Dr. Butler completed her PhD in demography and rural sociology at Penn State, and she enjoys reading, the outdoors, and exploring her home state. Welcome. Thank you for being here.
Hello? Hello? Okay, there we go. Hi, thank you for having me here today. I'm happy to discuss a topic I enjoy very much, which is Michigan demographic trends. And just to note a name change, and you can probably see the difference between the agenda and my slide deck here, we are now referred to as the Michigan Center for Data and Analytics. So to continue the introduction of the functions of my role in the demography team at the Michigan Center for Data and Analytics, we provide analysis of Michigan's changing population size and demographic composition. I serve as the lead for the State Data Center and the Federal State Cooperative, which means I serve as Michigan's liaison with the U.S. Census Bureau for many programs, including population estimates and data dissemination. We also serve as advisors for state and local leaders, nonprofits, the media, and the general public on population and demographic data. So in the first part of the presentation today, I'm going to be focusing on Michigan statewide trends, looking at changes in the total population. And then after that, thank you. After that, we'll, and during this part of the presentation, we'll also examine some underlying dynamics that contribute to those changes in the total population. So here we're looking at Michigan's total population all the way back from 1900 through 2020. And what you can see is in 1900, we were about 2.5 million, up to about 10 million in 2020. Michigan had the most rapid rates of population increase from the 1920s up through about 1970. From 1970 through about 2000, you could see that those more rapid rates of population growth leveled off. And from 2000 to 2010, Michigan experienced slight population decrease, and this was during the Great Recession, as I'll speak to a little bit later. From 2010 to 2020, there was a little bit of a recovery, but as you can see, Michigan's population has hovered around the 10 million mark for basically the past 20 years. So overall, Michigan's population growth can be characterized by slow growth and population decline since the 1970s. And if we look at population change in between the two most recent censuses from 2010 to 2020, Michigan's population did grow by 2%, but that's compared to 7.5% nationwide. And if we do a direct state ranking, Michigan had the 46th lowest population growth rate among the 47 states that did experience growth in that time period. And when we look at more recent estimates of population change in the state from 2020 to 2022, we can see that Michigan was among 19 states that experienced population decline. Now, this was a period where a lot of states, as you can see, were also experiencing population decline. The U.S. overall was experiencing a low rate of growth, and in fact, the rate was historically low from 2020 to 2021 for the U.S. However, even when we're doing another state comparison, Michigan ranked 43rd among states in terms of its rate of population change from 2020 to 2022. So that means the first state would have had the highest rate of growth, and the state that ranked at the bottom would have had the most severe rate of population decline, and Michigan ranked 43rd in that group. So now I'm going to briefly discuss some trends within the state of Michigan and look at population change across the state. So here we're looking at population change across Michigan from 2010 to 2020. And in this map here, we're looking at the percent change in population in Michigan cities and townships from 2010 to 2020. So the areas of orange represent population decline, and the areas of green represent population growth. As you can see from this map, growth in this 10-year period was concentrated in southeastern Michigan, Grand Rapids, and Traverse City, whereas decline was concentrated in the Thumb, the northeastern Lower Peninsula, and much of the Upper Peninsula. Now, it's interesting to note that more recent estimates of population change from 2020 to 2022 actually show some interesting kind of patterns where the southeastern part of the state experienced population decline in this most recent 2-year period, and where there was actually very slight population growth in areas of the Thumb, the northeastern Lower Peninsula, and much of the Upper Peninsula. However, the growth here was so slight, and most of those areas have not recovered to their 2010 levels. However, it is an interesting trend, and it will be interesting to see in further data releases whether this is a short-term or a long-term trend in the state. So now I'm going to shift focus to the dynamics of population change. So since experiencing slow rates of population growth and even periods of population decline since the 1970s, Michigan has remained in the top 10 most populous states in the US. And so it's interesting to see what demographic dynamics have contributed to historic and contemporary patterns of population change in Michigan. So in terms of the dynamics of population change, there are only 3 components to population change: births, deaths, and migration. These are commonly expressed in what is referred to as the demographic balancing equation, which you can see here. So in this case, we could take our population in time 2, using the example of 2020, and that's going to be the sum of 3 components. It's going to be the population in time 1, let's say 2010, plus the natural change that occurs in that time period, that's births minus deaths, and plus that third component of net migration, which is in-migration minus out-migration. When there are more births than deaths, this is referred to as natural increase. When there are more deaths than births, this is natural decrease. And when we're looking at that net migration component, it's important to note that migration consists of domestic, so it's state to state, and international components. So in the first part of the presentation here, I'm going to focus on net migration, which once again is in-migration minus out-migration. So here's a chart of Michigan's net migrants from 1970 to 2022. And as you can see in this chart, overall Michigan historically in this time period has had net migration, with the exception of a few years where we were slightly net positive. You could see that net out migration was particularly severe actually during the 1980s. And then once again severe from 2000 to 2010, the Great Recession period. An important distinction to note between these two patterns, though, is that in 1980s, some of this migration loss was offset by births in that time period, whereas in 2000 to 2010, there were not enough births to offset the loss due to net migration. So here we're looking at net migration patterns of a specific age group, prime working age adults who are ages 25 to 54. So 25 is good because for those who are completing their college degrees, it typically gives them some time to complete those degrees, and up through age 54 because 55 plus tend to be kind of more getting closer to retirement and exiting the labor force. And we're looking at the time period from 2005 to 2021, so a more recent time horizon. And as I'm sure many of you know, there's a lot of reasons to focus on prime working age adults. They tend to be the ones actively seeking jobs, fulfilling our labor force needs. And what you can see from this chart is that in this time period, Michigan most years is net negative in terms of we lose more people of prime working age than what we gain. We are seeing that there was a recovery since the lows during the Great Recession, and even a few years that are net positive, but once again, in more recent years, kind of trending back to net negative. And when we look at the two components of population change, looking at domestic and international, here we can see international is the dark green line that's set above 0, that represents net positive migration. Domestic is the light green line that's below 0, that represents state-to-state migration. And what we can see here is that International migration in Michigan partially offsets domestic migration. And in fact, there are actually a few years where the net positive international migration was high enough to bump the total net migration in Michigan to slightly net positive. And so now I'm going to shift to the natural change component of the demographic balancing equation. So the first part that I was discussing, net migration, is often referred to as a first-order driver of population change because it has the direct effect of adding and subtracting people from a population. However, net migration, if we have sustained outmigration of young adults, that's also going to impact the prevalence of births and deaths in a population. So we'll kind of understand how that affects this natural change component in Michigan moving forward. Here we're looking at historical natural change in Michigan from 1900 to 2021. And again, natural change is births minus deaths. And so the dark green line represents the number of births in Michigan. The dotted green line represents the number of deaths in Michigan. And that light green line represents the natural change, which is births minus deaths. So for births, what you can see in this chart is steady trend upward from 1900 up to about 1960. We had a peak in births in 1957, above 200,000. And then you could see from 1960 onward, it's generally a decline in births down to about a little over 100,000 births in 2020. And there you could see there are a few smaller peaks in between in the 1970s and 1990s. In terms of deaths, you can see in that dotted green line that there's a steady increase in the number of deaths. Keep in mind this is a very long sustained historical time period, and as a population increases, you're also going to see an increase in the number of deaths. But of note, if we focus on that line and we look from 2010 basically forward, we can see that there's kind of this upward tick in the number of deaths. And we can attribute this to the aging of a large generational cohort, the baby boomers, into higher mortality age classes. However, as we see in 2021, the births and deaths line crisscross, and this is the first pandemic year where we had the highest annual percent increase in the number of deaths in history. This is also a demographic precedent and historical precedent in this year because it was the first year in this time period that Michigan had more births than deaths, which is representing that inflection point from natural increase to natural decrease. And so if we shift our attention to that natural change line, that's that green line, and what you can see is that basically from 1900 up to that peak in births in 1957, that line tracks very closely with the number of deaths, meaning it's being more tracks closely with the number of births, meaning it's being more influenced by number of births. And from 1960 through 2020, you see that there's this increasing kind of gap growing between births and that natural change line, which indicates that deaths is becoming a more prevalent influencing factor on natural change. And in 2021 and 2022, both of those years represented natural decrease years in the state of Michigan, which means more deaths than births. So also something I want to mention, for the births line, you could see that it's generally a pattern of decrease in births since the 1960s, but you can see that the decline is of greater magnitude from 2000 through 2020. So there are a few different factors that can impact the number of births in a population, and one of those factors is the total fertility rate, which represents the average number of children per woman. And in this chart, you can see Michigan, the United States, is the light green line. Michigan is the dark green line. And from 2000 to 2021, you can see that Michigan has had a consistently lower total fertility rate than the United States. However, the general trend line is the same, where total fertility rate is declining in both of them, and actually declining to an extent in the US, where it's converging downward to meet Michigan's total fertility rate in most recent years. So when we're considering that decline in births from 2000 to 2021, we have a declining population of women in childbearing years in this period, but also we're seeing that there's a declining average number of children per woman, so among the women who do reside here. So again, to kind of characterize and summarize this section, considering population growth in Michigan in most recent decades and years. Michigan is characterized by slow growth and population decline. And when we consider the historical and contemporary dynamics of population change, we have persistent net outmigration. We have persistent net outmigration of prime working and family age adults. We have declining birth rates since the 1970s. And then we also have recent increases in mortality due to the aging of the baby boomer generation and the impact of the COVID-19 pandemic. Now, it is important to note when we reach that inflection point of natural decrease, the births and deaths line, we're trending toward that anyways, and we likely would have hit a period of natural decrease sometime relatively soon, even in the absence of the COVID-19 pandemic. And then in 21 to 22, reiterating, Michigan experienced population decline due to persistent net domestic outmigration and natural decrease. So for this third part of the presentation, I'm going to pivot to the population aging in Michigan and implications for the labor force. So as I'm sure many people are well aware, Michigan's population is aging. That means there's an increasing proportion of our population in older age classes. The median age in Michigan increased by 4.3 years between 2001 and 2021. It's important to note, this is a nationwide trend. It's a trend in many countries across the globe, but the issue is more acute in Michigan. Michigan's population is aging at a faster rate than the nation. So for a state comparison, Michigan was the 29th oldest state in 2001, but was the 14th oldest state in 2021. And if we limit our comparison group to Midwestern peers, Michigan had the largest increase in median age among Midwestern states in the same period. And it's important to consider the implications of aging when we think about total labor force participation rate and thinking about the impact on our workforce. So here we're looking at Michigan's total labor force participation rate, and the labor force participation rate represents the percentage of the population that is actively seeking work or that is either working. And so here we're looking at Michigan's total labor force participation rate from 1976 through 2022. And in terms of labor force participation over the life course, labor force participation tends to peak in those prime working age years, as you might expect, and then it generally falls as people get closer to retirement and they exit the labor force. And in fact, the main reason for exiting the labor force is retirement, as you might expect. But in terms of implications, this means that there are fewer people who are working or actively looking for work, which contributes to decreasing labor force participation as the population ages. So here we're seeing a direct impact of population aging on labor force participation rates. So in this chart here, we've bracketed the area where baby boomers are turning 55. And what we're seeing is, as a large generational cohort, baby boomers have aged into retirement years, labor force participation rates have steadily dropped from 2002 through 2020. And, there are a lot of factors that influence labor force participation rate. But as you can expect, if we consider the impact of population aging and labor force participation over the life course, and we have more acute effects of population in Michigan, the implications are that we have a large proportion of our population who is not working and fewer younger adults in prime working age years to support needs and services for that population, such as healthcare. So this can also contribute to labor force shortages. So here we are looking at the prime working age population from 2000 to 2050, and the projected values are represented in that dotted line on the chart from 2022 through 2050, and the historical values are represented by the solid line from 2000 to 2021. And I would like to thank our colleagues at RSQE, whom you just saw present, for providing us this data, allowing us to interpret and present on it. So before I interpret this chart, it's important to note that this is a forecasted net positive migration scenario for 2022 through 2050, and essentially the assumption here is that there will be less severe rates of net domestic outmigration, which will be more than offset by positive rates of net international migration. So as you can see, when returning to the chart from 2022 through 2050, There's a projected increase in the prime working age population from 2025 through 2045. However, if this increase is rather slight when you consider the projected population in the 2040s is smaller than the prime working age population in 2008 and 2009, and even much smaller, and quite a bit smaller if we go even farther back to a comparison of 2000. So overall, this is a relatively flat growth trajectory in terms of the number of working age people. And this is even in a positive net migration model where there's enough international migration to offset domestic loss. And we could see this flat growth trajectory even more clearly when we consider the share of the prime working age adults relative to the total population in the next slide. So here we're looking at projected change by age group from 2021 through 2050. And just to provide kind of some statistics, so the share of prime working age adults ages 25 to 54 is projected to remain at 37% of the population in 2021 and in 2050. So this is actually a flat growth trajectory, even in a net positive migration forecast. And if we look toward the younger and older ends of the age distribution, we see some substantial shifts over that same time period. So if we look to the younger population, ages 0 to 24, that population is projected to decrease by 5% from 21 to 2050. And if we focus on the share of the older population, ages 55 plus, we see that they are projected to increase by 14% from 21 to 2020. So in my kind of concluding notes here, considering key takeaways on population aging and implications for the labor force. Historically, Michigan has had net negative migration among prime working age adults, meaning that we lose more prime working age adults than what we gain. And even in a population forecast with a net positive migration scenario where there's enough international migration to offset domestic loss in most years, the share of people in prime working age years is projected to remain flat. By comparison, we're seeing that younger populations projected to decrease while the share of the older population is projected to increase. And this presents challenges for, as I've said before, an aging population which has higher needs for services such as healthcare, but no significant growth among the prime working age population to provide labor for those services. And if we look even farther afield into the future, considering that decrease in the youngest age cohort, decreasing shares of this youngest age group means that there will be even less replacement from younger age cohorts and fewer people aging into prime working years to sustain our labor force. So if you have any interest in staying up to date on Michigan population and labor market information, I know everybody has seen the slide deck. Information is available here, as well as additional contact information here. So thank you for allowing me to present today, and please let me know if you have any questions.
I say thank you for your presentation. On the labor force participation rate, are you seeing any changes on older people working longer?
So I will say, for any labor force participation
Yes,
rates,
RSQE.
I sourced RSQE, maybe if they're okay with me putting it on the spot, but also if you have any follow-up questions, our labor force, our labor market information team, and we also have economics research team that could answer those. They kindly helped provide me some data for today's presentation.
So thank you, Jacqueline. This is really interesting information. Very sobering, of course, to see that crossover line between the births versus deaths. I was curious on some of the, out-migration patterns. Have you actually done any kind of analysis below that to see what are the causes of those out-migration? Is it for job opportunities? Is it for other purposes?
So the most common reason nationwide that people relocate, especially if we're talking about cross-state relocations, which is oftentimes a subject of interest, is family and jobs, as you might expect. But in terms of, other reasons for in-migration and out-migration, it's, of course, complex, but I would say family and jobs are primarily the biggest drivers.
Can I jump on that same train of thought? Are there, and I don't want to ask you maybe a public policy question, but I'm wondering if there are any commonalities between states or countries that that significantly see positive in-migration. Is that something you can speak to?
So some of the states and regions in the United States that are experiencing the largest growth have actually some, there's interesting trend where births are declining downward everywhere, even in states that historically have had the highest fertility rates, but are experiencing the most recent population growth, such as Utah. So, states out west, Mountain West, Colorado, Utah, I'm sure everybody has heard, a lot about that. States, Arizona, states in the southeast, such as Georgia, that are experiencing a lot of population growth. Within the most recent 2-year period, a lot of that growth has actually been to domestic net migration. So major metropolitan areas in those cities, I also forgot to mention Texas and Houston, Austin, attracting younger working age population and residents from other states. So population growth pretty universally now in the U.S., especially in the past 2 years when there was kind of this historic slowdown, especially in 2020, and international migration is just increasingly being driven by, in those growth states, by domestic migration as opposed to that births component, which even in the highest fertility places such as, say, Utah, relative to the U.S. average, they're getting just a lot of growth from other states. And even in places like Utah, a lot of that growth is coming from states like California, which are actually experiencing net domestic migration. Net domestic loss.
If I can follow up on this. And first, I should also thank you for your presentation. This is really, it's fascinating. Can we pivot then to in-migration from other countries? Are there either public policy drivers or are there other components that we have seen influence in-migration from other countries?
So immigration, as you might expect, especially compared to domestic state-to-state migration, is more influenced by federal policies. And in terms of international migration, in Michigan is in alignment with national trends where there was a slowdown in international migration from 2016 through 2020, and then during the pandemic period, historic low for the U.S. It was also low for Michigan. Michigan has a slower, we have a smaller rate of international migration compared to other states, but in terms of, what controls are on there, immigrants, just similar to domestic migrants, are generally attracted to jobs, available employment opportunities are going to follow that, but there's just more kind of regulations on the level of international migration in terms of federal laws. And I wouldn't be able to tell you the exact distinction in different states between how much leverage or control that states have over that.
Thank you for a very informative presentation. When I looked at the figure that you had for international migration over time, it kind of frustratingly began in 2010, which we're still really experiencing, I would imagine, the impacts of the Great Recession. Mm-hmm. So historically, was it higher before that, or like over time, where are we over a greater period of time, like from the 60s, 70s, 80s?
I am not sure on the specific
Okay.
answer to that question, but if there was any interest, we could break out that net domestic migration component going farther back to historical period.
International is what I'm talking about.
Yes, we could break it down into domestic,
Okay.
international, and see what international looks like farther back than 2010.
Okay. I guess the reason I ask and the reason I'm interested is because, of course, with Michigan's dominance in the nation on agricultural diversity, that makes us uniquely situated to be in need of farm workers to harvest, plant, and take care of the hundreds of different agricultural products we're growing here. And, in my work around the state as the chair of the subcommittee on appropriations of ag, I have heard over and over again about labor shortages. And it seems like with a need for 20,000 annual employees in that sector, international immigration has typically been very helpful for us. So do you see the trend increasing given the expiration of some of the COVID protocols?
So in terms of looking at net international migration in the past 2 years since that COVID low in Michigan and also again nationwide, we have seen some recovery in net international migration. And in fact, in 2022, the positive net international migration was enough to offset domestic loss and bump Michigan's overall net migration rate to slightly positive in 2022. So the answer to that is yes.
So if that trend continued, that could actually be very helpful for us in terms of filling those jobs and.
So given that the natural change components, we're thinking about births minus deaths, and given that we have seen over time this kind of increasing ratio of deaths to births, even to the point of natural decrease, within the past 10 to 15 years in particular, when we're thinking about important sources of population growth, immigration has been an important source of population growth in Michigan. So Michigan has a lower rate of international migration compared to many states, but in terms of a source of population growth, like say even compared to Utah or California, which are, have different kind of demographic profiles, international migration is an even more important source of population growth in Michigan relative to that natural change component, births and deaths. And that's been consistent since at least over the past 10 years. And so when we look to the future in terms of potential sources of population growth, if we're going off of historical trends, that would remain the case.
I have a question on your slide, Michigan's net migration of prime working age adults, ages 25 to 54. There's a period that is positive. Do you have any ideas what that was? Why?
I do not have a direct answer for that. And it is positive, and it was part of that kind of upward recovery from that low during the Great Recession. But if you look at the overall number, it's,
Oh, no.
sorry, oh.
I want that.
It's around 10,000,
Yeah.
and from that 2016 to 2017, whereas, looking at net out migration, the previous low was around negative 25,000. So I actually couldn't speak to the exact factors there. I'm sure maybe I'll defer to my peers. It could have been more employment opportunities or jobs, possibly. I'm not exactly sure.
Any other? Oh, go ahead, Chris.
Apparently, we've found the topic I'm really interested in. Your slide relative to population changes from 2010 to 2020 with the map showing cities and townships is pretty interesting. And I guess many of the things you've said indicate that Michigan is tracking along several of these kind of national trends as well. But we're seeing here a real show of rural versus urban. Is this the same trend that we're seeing in other states, that there's a real concentration of population then within some of these urban areas and that rural areas are struggling, or is that something that's kind of specific to Michigan?
So in terms of population decline in rural areas, since at least the 1960s nationwide, even in county-wide analyses, generally the case has been that population growth has been slower, if not periods of sustained population decline in rural areas in the United States. And much of this is driven out by net outmigration, particularly of younger adults, to more urbanized areas. So the pattern of urbanization and looking at rural areas historically losing more than what they gain and younger adults leaving for cities, that is not unique to Michigan. And if we looked at change, even in a longer time horizon than just 2010 and 2020 in this map, we would find that there are probably quite a few areas in the state that did have sustained outmigration and subsequently population decline, either over multiple years or a rather high number of years over a time period. So that is not necessarily unique to Michigan. But when we look at more recent patterns during the pandemic from 2020 through 2022, in Michigan, there's some evidence to suggest that some of that outmigration was less severe in that period for some of these areas. And this is also a trend that you saw in many areas of the United States where, and particularly when looking at internal migration within a state, which is actually the most common move. Those cross-state moves are less common than people generally will remain in the same county where they live. If they do move, it's probably more likely to be to a county over. But within the pandemic period, especially in 21, that first year, there were some interesting kind of reversals nationwide of historic patterns where either net outmigration was less severe, or there were even some, especially more higher amenities, rural areas that experienced net positive migration. And this continued to some extent in 2022, the trend was less pronounced as we kind of were getting closer toward that recovery period. But, it's an interesting trend. It is important to keep in mind magnitude and also your comparison points, because even if it's slight growth in an area, thinking kind of over a long-term horizon, does that represent a complete recovery to, say 2010 or 2000? But nonetheless, it's an interesting trend, and it'll be interesting to see whether it persists farther into the future.
Thank you so much. Really interesting information. We thank you for being here.
Thank you.
All right, we will turn now to staff estimates. We will begin with estimates of K-12 pupil membership and the foundation allowance. We will invite up Ryan Bergen from Senate Fiscal, Jacqueline Mullen from House Fiscal, and Beth Bullion from the Budget Office.
Thank you for having us. I'm Ryan Bergen from the Senate Fiscal Agency, here with Beth Bullion from the State Budget Office and Jacqueline Mullen from the House Fiscal Agency. We're just here to present our revised estimated pupil memberships. It's actually very close to our January consensus. What you'll see generally is a continuation of trends, which is that overall pupil memberships are projected to continue to decline year over year, mostly for demographic reasons that were just covered in the previous presentation. But within those trends, you'll see that local school districts continue to experience the bulk of the declines, whereas public school academies will continue to see slight increases year over year. So I'll start with the revised estimates for the current school year, the FY 22-23. We did receive audited results of the September count of the fall count, which caused us to lower our projections slightly. You can see local school districts came down about 600 to 1,248,700, and public school academies we lowered about approximately 100 to 150,400. That would mean a change year over year of approximately a decline of 6,000 pupils total, about 6,200 in local districts, and increase of about 200 in public school academies. What we did not see, though, is necessarily that this slight decrease from the audit would carry through in a significant way into the future years. So our estimates are largely unchanged for FY24 and FY25. You can see that our estimate for local school districts for fiscal year 24 has declined 200, and our estimate for public school academies is the same. So that would have a total pupil membership in fiscal year 24 of 1,393,600, or a decline of 5,500 from the previous year. And our revised estimate for FY25 is a decrease from the January estimate of 100 pupils in local school districts, and again, no change for public school academies. So that would be a change year over year of approximately decrease of 5,100 pupils from our revised FY24 numbers. You can see our estimates for the dual enrollment, non-public dual enrollment costs in Treasury remain unchanged at $3 million for FY24. And with the revised pupil numbers, the membership adjustment factor for FY24 is now 1.0039, and the membership adjustment factor for FY25, based on these new estimates, is 1.0037. With that, I guess I'll take any questions we have about the pupil counts. Thanks.
So, over the last couple of conferences, we've been talking about, the kids that detached during, especially the beginning of the pandemic, and we're hopeful that they would reattach to some district going forward. At this point, do you think this is it? We're not going to see any kids return that will be reflected in these numbers?
I would say that our estimates, just like in January, are still projecting some return of those kids. Again, it's difficult to tell exactly when they will come back or what grades they'll come back to. But I think I said this in January, that from 2010 to 2020, we typically would see decreases of between 10 and 12,000 pupils per year, year over year. Demographic trends have slowed somewhat, but without an assumption of pupils returning, we would still likely be seeing decreases probably around the 8,000 per year range. So this does still show some number of kids coming back.
All right, thank you. I think what we're going to do is hear from all of the caseload proposals and then vote on them as one batch at that point. So thank you very much. All right, at this point, we will turn to estimates of human services, including childcare and Medicaid caseloads and costs. Starting with childcare caseloads and costs, we will bring up Corey Savino from Senate Fiscal, Noel Benson from House Fiscal, and Joel Durr from the State Budget Office. Thank you.
Thank you. Corey here. With the overall consensus agreement for the Child Development and Care Program for FY23. A total of $439.2 million is estimated for the remaining of the year. This is a $76.1 million increase from the current year level. This is due to a significant increase in cases of just under 27% for 20,000 for the year, which brings cases back to the pre-2020 program levels. Also, there is a 7.7% increase in the cost per case, bringing cost per case up to $1,830 on average. Overall, of the $439.2 million, a portion of that can be supported with remaining work project balances from FY22, with the remaining being supported with ongoing funding. Additionally, there is $4.6 million general fund needed to maintain the current FMAP matching requirement for the remainder of the year. For FY24, there's $364.5 million estimated, which is a $1.4 million increase from current law level. This is due to a combination of a continued increase in cases of 12.5% up to 22,500, and a significant decrease in the cost per case due to a temporary reimbursement rate enhancement ending at the end of this year, bringing cost per case down to 1,350. Of the total increase, there's no additional general fund needed beyond the current case, baseline adjustments made in the Executive, Senate, and House proposals. So with that, I'll turn it over for any questions.
No questions. Thank you very much. And finally, on this portion of the agenda, we will hear on other human services and Medicaid caseloads and costs. We will invite up John Maxwell from Senate Fiscal, Kevin Korstra from House Fiscal, and David Fosdick from the State Budget Office.
Thank you. Good morning. On behalf of my colleagues, David Fosdick from the State Budget Office and Kevin Korstra from the House Fiscal Agency, I'm John Maxwell from the Senate Fiscal Agency. I'd like to extend a thanks to everyone who contributed to these 18 numbers that you'll see up here. There's a lot of work that goes into this. Since we don't do this in January, this is a one year that we do. Starting out with fiscal year 23, we have an overall increase of $939.4 million gross, with a $444.4 million GF decline, which is representing of a decoupling between a gross and GF estimates, mainly due to the recognition of fiscal year 23 temporary FMAP increases, which are not included in the current year budget. For human services, this represents a $69.7 million gross decline and a $52.9 million GF decline. And then the health services is a $1 billion increase gross and $391.5 million GF decline. For fiscal year 24, this is the first year where it's mostly normal FMAP, given that only the first quarter of fiscal year 24 will have a 1.5% temporary FMAP increase. The overall decline in caseloads is $200.1 million gross, $61.3 million GFGP. For human services, this represents $42.9 million gross decline and a $38.2 million GF decline. For health services, this is $157.2 million gross and a $23.1 million GF decline. And then for fiscal year 25, there's a $507.2 million gross decline on the overall caseload and a $111.2 million GF decline. Essentially, fiscal year 25 uses the estimates from fiscal year 24, although there are some high-level adjustments. Given some of the uncertainty around Medicaid redeterminations, the reversal of the first quarter of the temporary FMAP increase from fiscal year 24, and then additional normal FMAP declines. The bottom line on human services is essentially unchanged from fiscal year 24. And then for health services, it's a $464.3 million gross decline and $73.7 million GFGP. With that, I'd love to take any questions you have.
No questions, thank you.
Oh, sorry. If I can ask just a clarifying question, acknowledging the change for FMAP, looking forward, I presume there are also pieces of this that factor in redetermination, and that begins in 24, right?
Correct.
Okay.
I think the calculation is 70% of the redeterminations in the estimate for for the entire window take place in fiscal year 24.
Great. Thank you.
Thank you very much. I'm sure I speak for everyone here at the table. We appreciate all the work that all of you have done on these for pupils, for childcare, and for human services adjustments. So we really appreciate all of the work there. At this point, if it's all right with my co-members here. I will take a motion to adopt all three of those proposals.
I will make the motion to adopt the pupil membership, the child development and care caseload number, and the health and human services caseload number.
Support.
Okay, all in favor?
Aye.
All right, thank you so much. All of those estimates are adopted. All right, we will turn to our final presentation of the morning. This will be the staff estimates, the Senate, House, and Executive economic outlooks, and revenue estimates. Inviting up David Zinn from the Senate Fiscal Agency, Jim Stansel from House Fiscal Agency, and Eric Busses from the Department of Treasury. Take it away. Thank you.
All right, good morning. It's a pleasure to be with you this morning. Before we jump into the presentation, I do want to take a brief second to acknowledge a few of the people who are behind the scenes. So there are a number of people behind the scenes at Treasury that make the consensus process possible. Andrew Lockwood, Melissa Gibson, and Tom Patrick Schuster. They don't get nearly enough credit for what they do. And specifically today, I want to thank Tom. So Tom has announced his intent to retire in November, so this will likely be his last consensus conference. He's sitting in the back where he likes to be, and I promised him I would not call him up and embarrass him, but I do want to just take a minute to thank him for his time. He began as a PhD economist after graduating from Michigan State. He served in state government for nearly 30 years. And over that time, we don't have the exact count, but we think he's been involved in between 55 and 60 of these consensus conferences. He's also our resident expert on inflation and has calculated inflation adjustments that impact every member of and resident of the state of Michigan. He's been a tremendous public servant, and just wanted to thank him for his many years of service before we started. So thank you, Tom. So with that, I'll be starting our presentation reviewing our economic outlook briefly and talking about some revenue updates that happened since the last consensus conference. Then I'll turn it over to Jim Stansel to talk about our major taxes, and David Zinn will close the presentation with a discussion of our revenue estimates by fund. So we'll be pretty brief on the economic outlook. We agree in most part with what you've heard from RSQE already. There are many clouds over the economic outlook for both the national economy and the Michigan economy. We see economic growth beginning to slow through the rest of 2023 and into 2024. We expect that slowdown to hit many sectors of the economy. The big story continues to be inflation. Inflation is still high, and we expect that to begin to slow. Our forecasts estimate that will reach about 3% by 2025. In terms of the Michigan economy, we share RSQE's cautious optimism that this economic slowdown might be a little different for the state of Michigan. We expect the Michigan economy to follow the national economy. We expect Michigan unemployment rate to be slightly higher in Michigan than it is in the nation, consistent with where it stands today. We do expect wage and salary growth to continue both in the number of people employed in payroll jobs and the earnings that they get from those jobs. We expect that to continue to be following the national trend. So the one economic slide we'll show with a graph is this one. This illustrates our view of real GDP. So this is the broadest measure of the national economy and the main benchmark by which we determine whether a recession has occurred. All three of our outlooks have a downturn in economic conditions. In January, all of us actually forecasted a recession. In this forecast, two of the three have a recession. The Senate Fiscal Agency forecast doesn't have us entering a recession and doesn't have really any quarters of economic negative growth, whereas the House Fiscal and Treasury estimates do have a very modest recession built in, and that's a theme that you'll see throughout our revenue estimates. So the first step we want to take today is look at what changed since January. And so far in fiscal 23, revenues have been tracking slightly below our latest forecast. This is in current collections, aside from any of the tax policy changes that have been enacted, since the vast majority of those have not taken effect yet. We're starting to see economic or revenue collections slow a little bit, but they're in surprising places. So normally, withholding, sales tax, and use tax are our biggest taxes, and those are the ones that drive changes in our forecast. But since January, our withholding, sales, and use tax is very much in line with the forecast we presented to you last conference. And we don't foresee huge revisions to those major taxes. The taxes that have been surprising have had to do with those taxes that file annual returns in April. So we had somewhat of an April surprise. One was good, one was bad. The bad one was related to individual income tax. So for both individual income tax annuals and refunds that people claimed when they filed their taxes this April or sooner, we fell short of target by about $450 million. The good surprise has been in corporate income tax. We had very strong annual payments and very strong quarterly payments for the first quarter of this tax year, and we're over our estimates by about $100 million. Setting all of those recent revenue collections aside, though, the largest reasons for revisions in our outlook in terms of revenue all relate to tax policy changes or tax rate changes that have taken effect since the last time we met, and these will be included in the consensus revenue estimates for the first time today. So the first one we want to talk about is the individual income tax rate. Last conference when we met, we talked about this and said, yes, there is this trigger defined in Michigan statute, but that calculation is dependent on the annual comprehensive financial report, which was not published. Since that conference, the ACFR, as we call it, has been published, and we can now make that calculation. The calculation isn't terribly complex, and Treasury made that calculation along with a number of members of the public, and determined that the tax rate will decrease for tax year 23 from 4.25 to 4.05. State statute requires that this rate officially is determined by the principals of this conference. So in the final consensus documents, we will be including that calculation for formal adoption. As I mentioned, the biggest changes in revenue since January have been related to tax changes, and these are outlined in this table here. These will all be built into our consensus estimates for the first time today. So you'll see shifts from these in all of our numbers. The first one is the individual income tax rate trigger that I mentioned, the decrease from to 4.05%. That'll reduce revenues by about $646 million over the 2 fiscal years. In addition, there were a couple large pieces of legislation enacted by the legislature and signed by the governor, Public Act 4 and then Public Act 20, 21, and 29. In PA 4, there was a redirection of corporate income tax, which used to be dedicated entirely to the general fund. That now has a provision that earmarks $500 million to SOAR, along with $50 million earmarks to MISHDA and a revitalizing and placemaking fund. So that takes another $600 million off of general fund in an ongoing way. In addition, the earned income tax credit and retirement tax changes under current law as enacted, the earned income tax credit will increase to 30% going back to tax year 2022. So we'll see kind of a double payment that will hit fiscal year 2024, as well as about a $380 million impact going onward. And then the retirement tax changes, which will be fully phased in by tax year 2026, and eventually lower revenue by about $450 million. And then the delivery and installation bills that will exempt delivery and installation charges from sales and use tax, lower general fund and school aid revenue by about $60 million. So in total, these changes to revenue are the largest drivers of what you'll see today. The combined revenue redirections and cuts will total over $1 billion for fiscal year 23, and just under $2 billion for fiscal 24. So with that, I'll turn it over to Jim to talk us through major taxes.
Thank you, Eric. Before we get going, I guess the one thing I want to say is, this can't be a revenue conference until we, again, redefine the difference between baseline and net revenues. So just to remind everyone, and this kind of dovetails on what Eric was talking about, when we talk about baseline revenues, we're talking about revenues that are in line with economic conditions, and then the net revenues incorporate any policy changes that may have taken place, either positive or negative. So we always like to point that out before we start. So looking at baseline income tax growth, starting in fiscal year 22, it was buoyed by employment and wage growth coming out of the pandemic, and that led to withholding growth of about 8%. And in addition, both quarterly payments and annual payments on a baseline basis were up over 10%, primarily on the strength of a very strong stock market and capital gains. We don't see that continuing into fiscal year 23, and in fact, all three agencies have kind of downgraded the estimate for withholding more to the 3% range, plus or minus a little bit, but so we're down from 8% withholding growth to about 3% withholding growth, and we're also looking at lower quarterly payments and higher refunds, and so both of those, or all three of those factors, are what are leading us to the different negative growth rates that you're seeing for fiscal year 23. In 24, they all turn positive to varying degrees. Not a lot of difference between them. There's a little bit more divergence in 25, but again, the differences aren't terribly significant, especially when you look at the numbers themselves or the revenue amounts. And so when you look at this, the table here, the chart, three things kind of jump out at you. The first is that we had almost $14 billion of net income tax revenue in fiscal year 22, and that's an all-time record. The second thing that should jump out is in fiscal year 23, we're all really, really close to each other. And then the third, the difference in our estimates high to low is about 1.5%. And then finally, as again dovetailing on what Eric said, all of our estimates are below the 22 level by about 1.1 billion. And again, that's due to, primarily to the impact of the trigger kicking on for 3 of the 4 quarters of 23, and some of the other factors as well. Although all 3 of us had positive growth rates on a baseline basis in 24, you can see that all of us are continuing to bring down net income tax revenue a little bit. And that's the perfect example of the difference between a baseline growth rate and then the impact on net revenues, because the policy changes are what's really driving this scenario. So you know, in this case, probably the biggest one in '24 is the increase in the EITC, because as Eric said, we're kind of doubling up on that payment in 1 year. So that's kind of what's pushing that down even further. For '25, we're looking to increase net income tax revenue somewhere between 600 million and about 1.1 billion, if you look at our individual estimates. We've got a very similar story for sales and use tax combined. So these are the combined baseline growth rates. Again, 22 is very, very high, but we don't anticipate that continuing into 23. Consumers are now realizing that inflation is really entrenched, and also with increasing consumer debt loads, there's some thought that it will constrain spending. That continues over into 24 a little bit. Our estimates converge somewhat. The House is still the higher of the three in both years. And then by the time you get out to 25, we're all looking at growth somewhere between 1.3 and 2.1% from our prior years. So again, very, very similar story, as I said before, with sales and use taxes, with the revenues themselves. The spread's only about 1.4% between our high and low numbers in 23. The differential widens a little bit in 24. There's about a 290 million gap between the high and the low, but that's still only about a 2.2% differential. And as I indicated, we're all expecting some growth in 2025. But again, it's very subdued. Think back to Gabe's slide where it showed real disposable income flattening out. This is kind of the picture that results from that as far as sales and use taxes are concerned. So this is a new slide we've put in this time. And what it's showing, the total bar height represents fiscal year collections of the corporate income tax. And kind of the hashed bars, roughly halfway up, indicate the collections through April. And so this is just kind of showing us the pattern. You know, you can forget 2012 because that was the first year and we hadn't really established a payment pattern yet. But it's showing, you know, the proportion of CIT that we typically get by April compared to the entire year. And historically, it's been in a relatively narrow range. It's been roughly 40 to 48% of total CIT collections roll in the door by April. I mean, it varies a little bit by year, and certainly as you look at that, you can see the volatility of the CIT in general, the way it bounces up and down. But the relationship between what comes in the door by April and what we end up with is relatively close. So if you focus now on the very last bar for 23, you can see that our net CIT estimate in January, before we knew what collections through April were going to be, was about $1.76 billion. And year to date, we already have $1.13 billion in the door. So all three of us revised our CIT estimates upwards, somewhere between $250 and $540 million. And in fact, all three of us now for fiscal year 23 are estimating something in the $2 billion range or higher, but we've all crossed that 200 billion threshold, or 2 billion threshold, excuse me. This slide now just takes kind of the CIT revenue that we were looking at for 23 and then going forward, but now we're also adding to it MBT collections as well. And MBT collections are typically reducing this by somewhere in the range of 500 to 525 million per year, again, because of the certificated credits that still exist. And those are expected to, you know, persist into the early 2030s, I think is the last estimate I've seen. And so, you know, but again, we're looking at some CIT growth going forward. Certainly Senate Fiscal Agency is on that path. But the spread between our numbers again is only about 290 million in 23. It's about $530 million in '25. So our ranges are about 18% or 18% in '23, 37% in '25. We have far more volatility on this one, even coming to an agreement with each other, than we do on just about any other revenue stream that we look at. And again, that's because of the inherent volatility of the CIT in general. So for my last slide, we can do this with a little less drama than the CIT slides. Because there's not a lot of motion here. Obviously, as you know, the set is simply a product of the 6 mil tax rate and the taxable values. And taxable values will change either because of inflation, because of new construction, additional construction, or when property becomes uncapped when it's transferred between owners. In our case, we're looking at fiscal year '23 increase in taxable value and in set revenues of between 6.6 and 7%. It's about 4.6 to 5.4% in '24 and 3.3 to 4% in '25. One thing to keep in mind, as I said, when I mentioned that inflation affects this, the effect of inflation is lagged. So when we first saw inflation kicking in, that doesn't hit your tax bills until the next year. And so as we project inflation to come down, through '24, '25 and going forward, again, there will be a lag in how that affects taxable values. It's going to take longer for that reduction in inflation to affect taxable values as well. And I guess my closing comment in all of this is, these things obviously change a little bit year to year, whatever, but the taxes we just looked at represent roughly about 87% of general fund revenue and roughly about 85% of school aid fund revenue. So that's why we focus so much of our time on the biggies, because those are the ones that will really sway the results. And with that, I will let David take it over.
Thank you, Jim. I will talk about how these numbers play into the various funds that the taxes get deposited in. First, in terms of net revenue to the general fund, you can see that between some of the timing issues, particularly for '23 associated with the flow-through entity tax, slowing economy, and enacted tax reductions, we're expecting GFGP revenue to decline for the next 2 fiscal years. The spreads between the agencies range from about $400 million in FY23 to about $900 million in FY25. And if you think back to Jim's slide on corporate income tax, virtually all of that difference is because of our different CIT forecasts. So that's pretty much the difference between them. At the lowest levels in FY24, we're expecting about an 11 to 14% drop in FY24 general fund revenue compared to FY22. Although all of these fiscal years, I'd point out, would represent the highest revenues relative to pre-FY22. So while it's down, all of these years are higher than FY21 and earlier years. However, if you adjust these for inflation, FY25 actually looks more like FY12. And is down about 43% from FY2000 and about 7% from FY68. So in terms of the buying power of general fund dollars, just like Gabe mentioned, the effect of inflation on personal incomes, it has affected the state's buying power as well. In terms of the school aid fund, in terms of net revenue, we have limited change in '23 and '24. That relates to the slides you saw with Jim, with the relatively flat school aid, sales tax growth combined with the income tax declines. And those two sources by themselves for school aid fund are about 70%. So like Jim was mentioning, they're going to dominate it. All 3 agencies have similar forecasts. We have a range of about $300 million, which is less than 2% of revenue. I don't know if it's a sign that the earth will crack open and swallow us, but we actually are narrower in FY25 than we are in FY23. I'm not sure what that quite says about our forecasts, but There's not a lot of deviation there. FY22 was an all-time record high for school aid fund revenue, so all of the agencies are expecting a new high no later than FY25. And all of these years, because of that flat growth, these numbers are not growing at the rate of inflation. They're growing below inflation. And to make the same type of comparison as with general fund, the FY25 values would be down about 3% from FY08 and about 1% to 2% from FY95. So inflation has definitely been an issue there. In terms of this slide, if you want to skip reading all of our longer reports, this gives you the bottom line with the numbers. All of the forecasts expect revenues that are below January. And the declines are mainly focused on the general fund because most of the legislation that's been enacted has attempted to hold the school aid fund harmless for the changes. So as a result, the impacts fall on the general fund. This slide breaks that bottom line on the previous slide for the tax changes or the revenue changes from January into basically the components that reflect policy changes versus economics. And you can see that in FY23 and FY24, 2 of the 3 agencies felt that actually on an economic basis we would be getting more revenue. By FY25, only Senate Fiscal is expecting the economics to raise revenues. But you can see that on the bottom line, the impacts are all dominated by the tax changes that have been enacted since January. The Budget Stabilization Fund has provisions that require pay-ins if revenues grow by more than inflation, real personal income adjusted for transfers. If it exceeds 2%, you have to make a pay-in. There's a pay-out if real personal income declines. Nobody, in terms of their forecasts, had a pay-in during any of the fiscal years in terms of payouts. 2 of the agencies had payouts that ranged from 0 to $397 million in FY93 and FY94. A lot of that created by variations in the inflation forecasts as opposed to the personal income. And none of us had a payout estimated in FY25. In terms of the constitutional revenue limit in Section 26, which limits revenue from all state sources to 9.49% of a lagged value of state personal income, we're all anticipating a decrease in FY22. The final report will come out probably a month, something like that. A lot of that reflects the fact that there was a sizable increase in personal income of 9% in calendar year 20, but revenues grew even more by 11.4%. Given that we are all expecting revenues to decline from FY22 levels, but are all expecting personal income to show an improved performance relative to FY22, you're going to see the gap increase, and you can see that we'll reach new records, or at least we're projecting new records in FY24 and 25 below the limit. In terms of our forecast risks for the economic side of things, we like the risks to be balanced. However, like with RSQE, most of our risks are on the downside. The most significant offset over the last year has been that consumers have been resilient. Gabe and Danielle were talking to you about that. Likewise, most of our risks have to do with things that will impact the consumer side. How rate changes by the federal government will slow down consumers and businesses in terms of investment and consumption, and particularly how this plays out, because there's a lagged effect between rate increases and when it hits the economy. And so there's the possibility that they may slow things down more than anticipated, particularly given the concerns about the banking sector and lending. In terms of inflation, gas prices, and in August, the pause on student loan payments will be halted, and people that have outstanding student loans will have to begin those payments again. There is the potential that all of these could have impacts on consumption to further slow it down. And of course, Gabe and Danielle talked about the financial shocks due to the banking sector or the debt limit issue. In terms of tax revenues, not only do we have these economic impacts, which the first two bullets kind of cover, but there are two other hiccups that relate. One is potential changes to the revenue accrual process and standards of what needs to happen. A variety of changes have happened over the last few years. You probably recall the issues with the mega credits and with VMF. We also had some issues in several years with, it turns out, a bunch of payments from sales and use tax were credited to the wrong tax, and we had to make adjustments to baselines so that we were actually forecasting not off of cash, but actually what we were supposed to be getting. And with both the tax changes that are coming and the volume of some of these impacts, there's a lot of volatility there, and there are additional changes that are under consideration, and some of these will have potentially very big price tags associated with them. And those kind of tend to come after, like we saw with the mega credits, they come after the budget year is finished on a calendar basis, and it limits the ability to adjust to those. The last part has to do with tax programs that were enacted in 2017, the transformational brownfields projects and the Good Jobs for Michigan incentives. These allow taxpayers to capture tax revenue. The way it ends up working is it comes in, we see it in cash receipts, but then we find out that part of that has to be earmarked for reimbursement under the provisions of the statute. Like with the accrual process, a lot of this shows up late in the budget year, if not after the end of the fiscal year, and so it holds the potential to come as a surprise. And it's largely not forecastable, both in terms of the timing, because it depends on the specific activity that occurs in these very localized areas. So the amount of capture may not be related to anything going on in the state economy as a whole or the national economy as a whole. It relates to what's going on and to literally this piece of property sort of thing. And under the current limits, we expect that the 6 existing projects for Good Jobs for Michigan could reduce revenue by $200 million. And with the existing limit on transformational brownfields, it's almost $800 million. And some years these numbers may not be large, others they could be quite substantial. And to reiterate, none of these numbers are included in our estimates. And they're basically unpredictable. So with that, we're open for questions. Leave things on another negative note. You know, Gabe set me up well.
I have a question, David. I think this might be maybe mostly for you. I know that the differences in the net revenues are being driven primarily by differences in assumptions in CIT, corporate income tax. Can you just talk about the different approaches that were taken, or why are they so variable?
I think a lot of it is just CIT is inherently difficult to predict. You'd like to think that it goes along well with what's going on with the economy, you know, kind of like we'd like to think that the stock market kind of looks like what's going on with the economy. But just like with the stock market, there's a whole bunch of expectations components, and somebody decides to book a loss because they took over some other company or something like that. There's a lot of volatility in what underlies profitability. And thus will affect what goes on with tax revenues. And essentially, it's not quite, you know, the throw the Yahtzee dice, but there's an element of that in terms of how much do you think the underlying economics are going to drive what goes on with corporate tax receipts. And our forecast places a little more emphasis on growth relating to the economics. And I can't speak for the other two agencies, but I think, you know, we certainly were concerned about this in our forecast. The corporate income tax numbers are, you know, kind of eye-popping. They're record-setting. Every year we've said next year it's going to be down. In fact, you saw that with the slide with Jim in January. We told you next year it's going to be down. And there was every reason to believe, looking at the economy, it would be down. And yet, you know, we're all raising our forecast for FY23. And I think it just reflects different premias placed on the different components of uncertainty for the components of corporate income tax and corporate profits.
I completely agree with what David said, and just wanted to add one additional difficulty here is this isn't necessarily just Michigan businesses. So the way our corporate income tax works is, if you have a physical presence in Michigan, we take your corporate federal taxable income from the national level and apportion it based on sales. So it's not necessarily just the companies that you would think of that have a really large employment base or a lot of properties in Michigan, because it's really based on what that corporation is doing at their national level and how they're selling their end product into Michigan. So it really, especially with the some of the federal provisions on federal taxable income and the changes over the last 10 years, that's really made even estimating that much more difficult.
Does that mean that the base is expanding too, the number of individuals paying?
Yeah, we have seen a slight expansion. Certainly, when we went from the MBT to now, yeah, it's been a large expansion in the number of C Corps that are paying.
But even from 1 year to the next, so this year?
Yeah.
It's more the firm composition of which firms have big liabilities. That's much more variable now than it was under the earlier taxes.
Can I switch to a different?
I guess all I would say is I agree with everything David said, and especially what Eric said, because I was going to say that, so.
On your last slide also, so will these good jobs and these transformational kind of work like the MBT, where the strategic fund will let you know when things are happening? I mean, and is already things happening? Are these more future things?
So currently, we haven't made any distributions or payments under any of the agreements. We've worked very closely with the MEDC and are receiving data and updates from them. I would say most of these are very early in the process. On the good jobs for Michigan in particular, we haven't seen any claims. They have to, the way that program works is they have to meet certain employment thresholds and then can begin claiming on the withholding from those jobs. And we haven't seen anybody come and file a claim yet. But we hope after the first couple years of those, we'll be able to establish a pattern on some of those.
I want to thank you all for the work you've done, and I want to highlight how close these different forecasts are. This is really perhaps more in line with what we saw pre-2020 in terms of the different forecasts, but I appreciate that. And I would like to also thank you for your slide 20, which really breaks down some of the driving factors of these changes, right? So, and as David goes to this slide, I think it's really important that we all understand that these reductions that we're seeing in the forecasts are based on public policy changes that are meaningful public policy changes and purposeful. So I think this is a really useful slide for people to really understand what we're seeing in these forecasts. So I appreciate that.
I was going to make several of those same points, so thank you. But I also want to just acknowledge the tremendous amount of good work that's been done behind the scenes to even get us here. So there's been a lot of changes between January and now, and even, forecasting the future means you have to have some agreement of what today looks like. So I really appreciate the effort it took to synchronize your balance sheets, and also have such a tight forecast margin here. And I also want to acknowledge the quality of your January forecasts. I mean, you've really kind of hit those on the head. I know it's been a frustrating last couple of years with the economic indicators not giving you the normal steering that you would normally have. And January was a difficult conference, and you came together and gave some really great consensus numbers, and we've performed pretty much on those. So thank you again for all of that work.
I'll just say ditto. All right, well, we will take a break to go discuss the proposals. And again, thank you for the presentation and all the work. Thank you. We'll go at ease. All right, we will reconvene the conference. David, would you like to present, please?
Yes, so you've met and agreed, well, I guess you'll vote and then agree, but the proposal is to revise FY23 revenue, general fund revenue to $13.8 billion, a 9.4% decline from FY22, and $990 million below the January consensus. School aid fund revenue at $17.7 billion, and the combined at $31.5 billion, for a total drop from the January consensus conference of $883.4 million. Revising FY24's forecast, general fund to $13.2 billion, a $1.9 billion drop. School aid fund at $17.9 billion, a $42 million increase, for a combined total of $31.1 billion, a $1.8 billion drop. And revising the FY25 numbers to $13.9 billion in general fund, a $1.6 billion drop from January. School aid fund $18.3 billion, an $8.3 million increase, and for a combined total of $32.2 billion, down $1.6 billion from January. The revenue limit calculation would be, as shown here, would increase in 23, 24, and 25 in terms of the gap below the limit. You can see the forecast for long-term revenue trend, combined GFGP and school aid fund revenue growth of 2% in 26 and 2.7% in FY27. The rate calculation that was mentioned earlier, specifying that the tax rate under the individual income tax in tax year 23 would be 4.05%. These forecasts would lead to no pay-ins or payouts in terms of the BSF, and you can see these school aid index numbers related to the pupil counts that you saw. However, it looks like you are all looking at something up on the top part. What's the concern? Yeah. Those are from the prior year. Yes, those are year-over-year numbers. Yep.
Okay, right behind you. Uh-huh. Yeah. Okay, I'm following. Gotcha. Yep.
All right, any discussion? All right, I would entertain a motion to adopt the proposed consensus forecast.
I move to adopt the forecast.
All in favor?
Aye.
Opposed? None? The forecast is adopted. Thank you again. Thank you all for the work, and we will entertain comments at this time. Mary Ann?
I guess from my perspective on this, besides the fact that I know we've thanked everyone, the amount of work that's gone behind there, but for sort of the general piece of this is on our balance sheets, all of those tax changes have been accounted for. This is not in addition to anything. So that's not a complete surprise here that basically we were projecting the same kind of drops for those changes there. So just a clarification on that.
All right, with that, we will stand adjourned and see you in hopefully January.
Yeah.
Thanks.
Thank you.